to the needs of young investors. And joining in is Manish Taneja, co-founder and chief distribution officer at Z Funds, which focuses on simplifying mutual fund investments for young professionals. Manish, let me ask your perspective on balancing risk and reward, because that is crucial in any investment strategy. So I want to understand from you, what strategies can young earners use to achieve this balance in their portfolios, and how mutual funds can help in this process?
Right. So good afternoon, everyone. Thank you for inviting us. I'll just take a minute to explain what is risk and what is it that we need to keep in mind. So it's an old cliche, whether you drink water in Bangalore, Barabanki or Boston, the formula remains H2O. Similarly, the risk-return trade-offs remain same irrespective of which geography or which asset class you're investing in. So you need to keep in mind, every time you're looking for a higher return, you are building in risk in the portfolio. And by risk, I mean not only the returns not accruing, but the principal not growing in real terms or principal even eroding. And the corollary of that is that if something's given you a higher return over the last 1, 2, 3 years, please understand it's carrying a lot of risk in it. To give you a simple example, the risk-free return, if we were to say in India, is the rate at which the government of India can borrow, which is right now 6.85% for 10 years. Anything that you're looking to achieve over and above that, you have to start with the assumption that you're building risk in the portfolio, and the returns that you chase will always have risks in them. And anything that has given a higher return over the last 2, 3 years, and if you think that's going to continue to happen in the coming years, has a lot of risk built in. So that's the first thing. That's a thumb rule we always need to keep in mind when we are building a portfolio. Now, how do we manage this risk? At the end of the day, not doing anything is also a risk. Your money gets eroded in real terms if you don't invest. The free lunch of risk management, as they say, is diversification. It's an old way, the way we were taught when we were growing up. When you're traveling in a bus or in a train or public transport, don't keep all your money in one pocket, keep it in two pockets. So diversification is the free lunch of risk management. So diversify across asset classes. Don't put all your eggs in one basket. And diversify, mutual funds are a great way of diversifying, not only across asset classes, but also within the asset classes. So when you do a diversified equity mutual fund, you are basically participating in multiple companies. So important thing, the sooner we realize this, and I know there is a lot of recency bias and a lot of our investors come and say, oh, this fund's given this much return in the last 1 year, why don't we put more money in this? We always need to keep in mind that anything that gives a high return has a lot of risk built in. And as you chase higher returns, you are building in risk in the portfolio. And the best way to manage risk, one of the better ways of managing risk, and like I said, it's a free lunch of risk management, is diversify. Diversify across asset classes, diversify across instruments, and if possible, diversify across geographies. And mutual funds are a fantastic product to start your journey of diversification.
Absolutely. So the point here is that you should have a thali of options, as you say, when you're having your lunch. And as you mentioned, diversification is the free lunch for risk management. That's a quotable quote. Manish, selecting suitable mutual funds, that can be overwhelming, especially for young investors. So how can they make informed decisions that align with their financial goals and risk tolerance?
Right. So to give some context, one has to make peace with the fact that we are an over-communicated society and an over-communicated market, especially when it comes to business news. I don't think America has 6 business news channels and 6 business newspapers. On top of that, the sheer volume of content that is available thanks to social media, it's very difficult to break out from the noise and get an insight. So what I would advise young investors is find an advisor. Find an advisor. The mutual fund industry and the capital markets in India are fairly well regulated. There are certifications, there are examinations that people have to clear before they become financial advisors. So find a financial advisor and align their financial incentives with your financial goals. So get a financial advisor when you're getting started. And even if you've started, it's always a good idea to get a financial advisor. I mean, Roger Federer, after winning multiple Wimbledons, got Stephen Edberg to tell him how to get his game better right. So it's always a good idea to get an advisor, align their financial incentives with your financial goals. A financial advisor, a well-trained, well-certified financial advisor will always help you break the clutter. They will help you figure out the benefits and the power of compounding, because they'll be able to set you a right asset allocation model. A lot of times people miss out on the benefit of compounding is because their asset allocation is not right. They don't have money in fixed income. They don't have an emergency fund. So mutual funds, because they are wonderfully designed, they can be exited anytime. People exit their equity mutual funds and sort of miss out on the long-term benefits of compounding. So get a
Hmm.
financial advisor who understands your risk appetite, a financial advisor who understands how markets work, who's well trained, who's got experience, and more importantly, align their financial incentives with your financial goals. And that's the first thing I would suggest in terms of managing the risks in your portfolio.
Absolutely. And it's great to understand also that there is a lot of support in the system. As we mentioned, there are mutual fund managers who are managing, well, their universe. And now you, of course, have financial advisors who manage your universe of say, the choice of funds you want to make in service of the goals that you are seeking to achieve. So we are truly in interesting times where the power of knowledge, the power of awareness can help you reach your goals.